Hello, I'm Peter Hibbert and welcome to this month's short CPD training webinar, which is going to focus on the Charity SORP consultation. We've been doing lots on accounting and audit updates in the last couple of years on the periodic review of FRS 102. This was published in March 24 and takes effect from periods commencing 1 Jan 26. Lots of SORP, Statements of Recommended Practice, are awaited to complement the FRS 102 periodic review. The Charity SORP has been eagerly awaited and was published in late March of 25. There's a very short 12-week consultation on this, culminating on the 20th of June. And what we're going to do in today's short session is run through the key aspects of the SORP consultation draft and highlight one or two things to look for if you're perhaps considering responding in respect of the consultation. So there's our periodic review timetable. We had the finalised revised version of FRS 102 published in March 24. It's what we tend to refer to as the September 24 version. It was sort of published in a sort of a finalised format in its entirety in September. And as I say, will take effect from periods commencing 1 Jan 26. And that will also be the time frame for implementation of the SORP. And there it is, the September 24 version of FRS 102. The FRS 102 changes for periods commencing 1 Jan 24, the periodic review changes that were being contemplated by the FRC, focused on big changes that had taken place in the IFRS arena in the last 5 or 6 years. And it was all about whether we were going to, in the UK, embrace these changes as part of the revised version of FRS 102. Given that Statements of Recommended Practice, or SORP, complement the FRS changes, any changes that would come in here in respect of the periodic review would obviously have relevance to charities as well. And the SORP would take some time to, I suppose, explain how these particular changes would impact on the charity sector. And what, of course, has been very well trailed through lots of sessions we've run over the last couple of years has been that the IFRS 9 changes on financial instruments were not adopted by the FRC as part of the periodic review. The IFRS 15 changes were, this revenue from contracts with customers, and the IFRS 16 lease contracts were, and in a nutshell, I suppose, what that does, it treats operating leases like finance leases and brings many of these onto the balance sheet as obligations with a corresponding right of use asset. There's the headlines in terms of the impact of the on-balance sheet approach, which we will now see under the revised FRS 102. So lots of leases coming onto the balance sheet, culminating, as I say, in a lease liability and corresponding right of use assets. One of the big things, I think, in terms of lots of the courses that we're running currently has been around the scoping of the standard and which leases it will apply to. There are notable exemptions for short-term leases with less than 12 months duration and low value leases, and these can both be kept off the balance sheet and accounted for effectively as operating leases in the way that they currently are. So I guess for charities, the key consideration will be, is the charity applying the new FRS 102 a lessee? Will this therefore be relevant to it at all? And if it does have leases and it is relevant, are these leases where the short-term or low-value asset exemption will apply, resulting in the current treatment continuing to be used, which will therefore mean that the relevant leases can be kept off the balance sheet. Now, in advance of the SORP being published, we were talking a lot about 3 kind of categories of lease that possibly be relevant in the context of the Section 20 changes as they would apply to charities. So where the charity is a lessee and is paying market rate rental, the normal lease accounting rules will apply and the relevant lease obligations will come onto the balance sheet unless one or other of those exemptions will be relevant. Many charities, certainly in terms of property that they utilise, will pay nil or peppercorn rental. And from the point of view of the revised FRS 102, there's no obligation to pay rent in that situation. That will therefore continue, as is currently the case under Section 34 of FRS 102, to be a kind of a donation in kind. Where the agreement sits kind of in the middle, and there's an element of rent being paid, but that is a discounted rental, then it will be part lease, part donated service. That's something which the revision to FRS 102 would make clear. And that's something certainly that the SORP does expand on. The third situation there of the three is the one that will be challenging for charities that are embracing the revised FRS 102 for the first time for periods commencing 1 Jan 26. And then revenue from contracts with customers, that, as I say, is a completely new rewritten section of FRS 102, section 23. One of the key things to bear in mind, I suppose, from a charity point of view, is that not all charities will have revenue from contracts with customers. Many charities generate much of their revenue from grants or from donations. And if that's the case, this will not be relevant. But where the charity does indeed contract, then this 5-step approach will apply. One of the things we're focusing on a lot in this particular area is around situations where there is a contract with the customer, which involves the delivery of various performance obligations, various promises. And what will be thought about more under the revised FRS 102 is the need to kind of identify what those individual performance obligations are, what those promises are, and apportion the overall revenue from the contract with the customer to the individual performance obligations, and then recognise income in the SOFA in the appropriate way off the back of that process. That's a key consideration that will apply to any company, but will apply to charities also, where it does have revenue from contracts with customers. Okay, so that's kind of an overview of where we are in terms of FRS 102 generally, and some of the key considerations from a charity point of view. As I mentioned, the charity SORP, the Statement of Recommended Practice, will basically provide more clarity on the way that those particular changes will apply in the charity sector, and then provide some additional change requirements as well in terms of the way that charity financial reporting will work. And that's why I suppose fundamentally it's been eagerly awaited. It has been issued in exposure draft or consultation draft format right at the end of March 25. As I mentioned, there will be now a 12-week consultation culminating on June 20th, and that will then provide the basis for the revised final version published in October for implementation for periods commencing 1 Jan 26. And there it is. There it is. So 12-week consultation to June 20th, a short consultation period. So much a possibility here for people who have got an interest in this to review the SORP in some detail. There is a full SORP available through the Charity SORP website, www.charitysorp.org, a very useful key changes paper. Also, various professional bodies, including ICAW, are running consultation events, but anyone can put their response in relation to the consultation, and the invitation to comment is there. But be quick, because that window closes, as I say, on June 20th of this year. So, the highlights. First thing that the revised Charity SORP does is it introduces a tiered reporting system. And this, I think, is quite usefully portrayed throughout the SORP, where at the start of every single chapter or section, it really makes clear what's required of different charities within different tiers. And the tiers are Tier 1, any charity with income of less than $500,000, the smaller charities. Tier 2, any charity which is not small, but's got gross income of not more than 15 million. And then Tier 3, any charity with gross income falling above the Tier 2 threshold. From a financial reporting point of view, my perception is that although Tier 1 ostensibly provides an easier ride for charities that are small, from an accruals accounting point of view, particularly with the new rules on revenue recognition and lease accounting coming in, it's a tough place to be. And we'll see that coming through over the next few minutes. So, Trustees Report section has been completely rewritten. I think in terms of what's required of charities currently, to a greater degree for the smaller charities, it will very much be the same, with a differentiation between what's required for charities that are small, less than $500,000 income, and those that are larger. That's already a requirement, isn't it, in terms of the charity sort of differentiate between the requirements for smaller and larger charities. We then do have the requirements for this third additional tier, of charities with income of more than 15 million. And yes, lots of the requirements there, very usefully included, are around sustainability and ESG. So those are things that a smaller charity could choose to incorporate, but the requirement there is only going to be for a larger charity where the income exceeds 15 million. But it is a complete rewrite, and therefore that trustees report section, I would say, is well worth a read. In terms of recognition of income, again, like all the sections, what this section does is differentiate between the requirements of Tier 1 charities, Tier 2 charities, and Tier 3 charities. It rather helpfully is structured in a way whereby it differentiates between, in the first segment, the needs of charities that are engaged in exchange transactions. And that sort of links into the 5-step income recognition model we mentioned a few minutes ago, with lots of good practical guidance around how that 5-step model applies for different revenue streams, like, for example, membership subscription scenarios. So quite helpful guidance there about specifics, but the 5-step recognition model very much applies and is reinforced there by that section of the income recognition chapter of the standard. Income from non-exchange transactions, very much as you were. So income from non-exchange transactions recognised when you meet the 3 criteria around entitlement, probability and measurability. So no substantive change there. Yeah, there is some more stuff in there on legacy income and the way the rules work in relation to income recognition in respect of legacies. I was certainly of the view that perhaps we would get a little bit more detail around what would be the key triggers for charities concluding that they had got entitlement to income in relation to legacies, perhaps compared to the previous version of the SORB. I can't see lots of additional guidance. Now, that might be one area, therefore, where they do get feedback that does get kind of ramped up in the final version when it's published later this summer. A completely new module, Module 10b, on lease accounting, brought in to reflect the requirements of the revised FRS 102. Now, lots of those requirements will apply to all charities, Tier 1, Tier 2, and Tier 3. In terms of structure, it rather helpfully articulates the various challenges presented by Section 20 of FRS 102 in respect of leases, and then talk through in some detail how they will apply specifically in the context of charity accounts. So quite useful guidance there about how to apply the revised Section 20 in the not-for-profit sector. Other changes brought in by the SORP in the exposure draft or consultation draft format. So tiered approach to the disclosure of remuneration with a less burdensome requirement for the smaller charities and a more burdensome requirement for the larger ones. My take on that, certainly from a Tier 1 point of view, there's not a huge amount of difference in terms of the disclosure around remuneration, transactions involving trustees, transactions involving related parties. The only real change from what I can see is the removal of a need to disclose total staff costs for a Tier 1 charity. I don't see that as being a massively burdensome or onerous disclosure. So from the point of view of remuneration, trustee transactions and related party transactions, I would say we're very much where we were as far as the new SORP is concerned. Minor refinements to the disclosure requirements in relation to related party transactions and ex gratia payments. So a requirement to disclose commitments in respect of related party transactions, even where those commitments may not have given rise to an accounting entry on the balance sheet. And also a clarification that where ex gratia payments take place, and these are not massively common, these would need to be individually disclosed rather than being disclosed in aggregate. So again, some refinements in the disclosure requirements that area. Nothing massively huge though, and very much as you were in that respect going forward for all charities. New SORP section on provisions, so unpicking the requirements on provisions from the current liabilities chapter and placing those in a new chapter, which I don't think is hugely impactful, but I suppose does logically differentiate accounting for provisions from accounting for liabilities more generally, in much the way that FRS 102 does. A really helpful change and rewrite to the sections on heritage assets and social investments. To me, the chapter on social investments particularly helpfully clarifies a number of things that I think before were quite confusing. So again, if you've got clients in that particular space, or if your charity is in that space, do read that section through quite carefully. I think quite helpful without changing anything fundamentally about the way that heritage assets or social investment accounting works in practice. Tier 1 and 2 charities exempt from the cash flow statement requirements, except where small, except specifically where small, based on the FRS 102 definition of what a small company is. Now that, I suppose, in a way is helpful. It probably brings more charities into scope for exemption from cash flow requirements. Based on changes to company law coming in from periods commencing 6th of April 25, the small company limits increase, and that will therefore bring even more charities into scope for that particular exemption. Two things to me that feel a bit odd there. We've already got a tiering system based on $500,000 income, based on 15 million income and above. Why have another tiering system based on the definition of a small company based on company law, especially when that definition is changing? Now, that to me feels a little bit clunky, I suppose, in terms of the detail. And I guess in a situation whereby currently so many organizations, charities included, are in a place whereby there's lots of financial challenges. If there's one primary statement that really tells a story about where an organization is up to in terms of its generation of cash and utilization of cash, the cash flow statement very much does that job. It seems quite odd in the current climate to remove the requirement for cash flow statements for more charities, but that very much seems to be the way it's going in relation to the consultation for charities defined as small based on the definition in Section 7 of FRS 102. And throughout the SORP, lots of really helpful examples, notably what was not there before that is there now, a useful illustration of what a SOFA might look like for a charity with a sort of more natural analysis of income and expenditure, in addition to the current disclosure examples for charities where they're doing their analysis on an activity-based approach. And the natural analysis of income and expenditure relevant for tier 1 charities has always been a possibility, but more example, more illustration there that I think is useful. Do take a look and form your own view on that. Okay, so that's where we are in terms of the key things to look out for in the consultation draft. Interestingly, just before we recorded this session at the start of April 2025, we were then made aware of a further consultation around the financial thresholds in charity law, with a possible move to increase the audit exemption limit for charities from the current 1 million. We already know that with effect from 31 December 26 year ends, we think the Scottish government's going to increase the Scottish charity audit limits to 1 million. So lots of consultation going on north and south of the border currently in relation to financial thresholds. We mentioned, didn't we, in the segment there on the charity SORP, there's clarification about what we mean by a tier 1 charity, a tier 2 charity, and a tier 3 charity. I just wonder whether in the final analysis, when this consultation on financial thresholds south of the border does culminate in a decision, and this consultation closes on the 12th of June, the SORP consultation closes on the 20th of June, we might possibly get a bit of a reconfiguration of those thresholds for tier 1, tier 2, perhaps based on where this consultation lands in relation to, for example, the audit exemption thresholds south of the border. So very much want to watch this space on over the summer as these two consultations close and the final decisions are made. In terms of our overall view, I think there are certainly lots of good positives here. I think it's well structured in terms of the consultation draft. Lots of very good examples, lots of really good, helpful application guidance. I would highlight particularly the application guidance in respect of lease accounting. As I mentioned a few minutes ago, the application guidance in relation to social investment accounting, which I think was weaker before, much improved now. And for those larger charities in tier 3, really helpful to see that what the SORP is now doing is very much embracing ESG disclosures for those larger organizations. Where it perhaps falls down continues to be the issue in my mind of the fact that for smaller charities, the SORP feels still to be disproportionately challenging. And I guess ever more so in a world where now we've got more complex rules around revenue recognition, more complex rules around lease accounting that align to IFRS. And in my mind, certainly for unincorporated charities and CIOs with income of less than 250K, although receipt and payments accounting is not everyone's cup of tea, that to me feels more than ever an appealing way to go, where that were to be available as a basis for accounting. As I mentioned a few minutes ago, I would challenge, are the tier thresholds right? In the other current consultations I mentioned on the previous slide, that might change, I guess, in due course. And yes, in a difficult world where so many organizations do face financial challenges, is it the right way to go? Arguably yes, arguably no, to exempt more organizations from producing cash flow statements, a very useful document for any reader, any stakeholder in a organization, charitable or otherwise. Let's just see where the consultation leads over the next 12 weeks and where those thoughts end up in respect of the final version of the SORB. Okay, hope that was useful. We'll be updating you on all those consultations throughout our courses in the spring, summer, autumn and winter of 2025. Any questions about the content in today's session, please do drop us an email, inquiries@insight-training.co.uk. And for our full programme of courses for 2025, www.insight-training.co.uk. Hope that was useful. Speak to you all again soon. Thank you.